Okay, this is now official. The Bank of England just raised the interest rate to 1.25%, but this is not just the Bank of England. It seems as if every central banks around the world are also raising the interest rates. In the US, the Fed just raised the interest rate to 1.58%. In Canada, the rate stands at 1.0% from the previous rate of 1% just a couple of months ago. And if that's not shocking enough, let me give you the Venezuelan interest rates, which stands at 60% comparing to 40% just last year. But the most important question is, what does this actually mean for you? So in this video, I'll be talking about why the interest rates are rising globally, and in theory, what would be the impact for all of us, comparing against what is actually happening. And I will also be digging a little bit deeper in terms of what the impact will be if you are a borrower, a saver, a homeowner, a renter, or an investor. So if this is something that you're interested to know, then please keep on watching. The central bank rate is a very important part of the economy, and it is the rate that other banks or retail banks base their interest rates on. If the central interest rate is on the rise, this means that the other interest rates will also be on the rise. This is because traditional retail banks will want to maintain a healthy gap between what they borrow, which is at the rate set by central bank, and what the banks themselves lend out to consumer. So for example, when the Bank of England interest rate was 0.25 last year, Lloyds Bank was giving out 0.1 interest on the saving account. So now that the central bank interest rate is higher than 0.25%, we should then be expecting the bank saving interest rate to be higher, which means that mortgages, bond yields, credit card rates will also be on the rise. Again, in theory, this is what should be happening, but what is actually happening, we'll look into that in just a second. So if you ever wonder why the central banks do change interest rates from time to time, so here is the thing. Central banks use rates as one of the tools to change their monetary policy. Normally, if the central bank decides to lower interest rates, that means that cost of borrowing will be cheaper. Therefore, this will encourage people to spend more, borrow more, and this will help in terms of stimulating a stagnant economy. However, if the central bank decides to increase interest rates, this will then make cost of borrowing more expensive. It will discourage people to spend money, discourage people to take on loans to buy stuff, and therefore the impact of this is that it will slow down an overheated economy. And this is the exact reason why central banks around the world are pushing to raise the interest rates now. Inflation is 40 years record high here in the UK and the highest since 1981 in the US. So the aim is to reducing inflation by increasing the interest rates, which will then discourage people to spend, and that way we can keep the inflation at bay. Well, in theory, because what is actually happening now in this time of high inflation is a little bit different. We know that inflation globally is due to many various different factors, let it be shortage of labor, supply chain crisis, and the rise of certain prices. But overall, the problem could be simplified into two different reasons. The first one is higher prices of goods coming from abroad. Secondly, a large increases in cost of energy. And therefore, with those two reasons being the main factor, different sectors will be impacted differently, and we can see that energy, motor vehicles, shelter and food are the most impacted by the inflation or increase in prices. And I want you to remember that graph just now really well, because that graph will make things make sense, especially when we're thinking about what I'm going to talk about next, which is what is the impact for us when the interest rates are rising. And most importantly, will the rise of interest rates bring down the prices of goods for us consumer at all? Because here is what higher interest rates won't do. Energy price, for example, made up of 30% of all the inflation last month, and this won't come down even though the interest rate is being raised. Food prices is another example. This one won't come down because regardless how much interest rates is, we'll still need to buy food, we'll still need to eat, so the food prices won't go down. And don't take my word for it. This actually comes from Jerome Powell himself.
Chair Powell, will gas prices go down as a result of your interest rate increase?
I would not think so, no.
Will the Fed's interest rate increases bring food prices down for families?
I wouldn't say so, no.
However, it will definitely slow down some of the interest-sensitive spendings. For example, some of the household goods or durable products such as cars or kitchen appliances, because those are the ones that for certain people they have to pay by taking out a loan or taking out credits. Another thing that the interest rate rise will help slowing down is the slowdown of the asset prices. With the interest rates being higher, less people will have an appetite to take out a loan to buy new assets. So for example, property, and companies will have less appetite to invest in assets such as machinery. So all this again will lower the demand and then stabilize the prices on these assets. In conclusion, increasing interest rates will bring down some of the prices but not all the prices, and this is kind of the complexity that we are facing in this point in time. And for borrowers, higher interest rates just means that the cost to borrow is going to get even more expensive. Now, if you're in debt already or if you have a loan that you need to pay off, it is now going to get more difficult. I did mention in the video that I made back in January titled Financial Goals for 2022, and one of the goals that I did mention for everyone to try to follow was to pay off the debt, because at that point in time I did predict that the government will be raising interest rates, and that is exactly what they have been doing. By the way, if you're finding this video helpful so far, then I would really appreciate it if you hit that like and subscribe button. Now, if you're a saver, this is actually a great news for you, because regardless of what you were earning before this interest rate rise, you would definitely be earning more now. Now, looking at Lloyds Bank interest rate for the cash ISA saving account, when the central interest rate was 0.25%, the interest rate was at 0.1%. However, now that the central interest rate has gone up by 1%, Lloyd's interest rate on the saving account has only gone up by 0.2%. So Lloyd's, it seems, is taking quite a pretty big gap here in terms of what they want to pay out for us in our saving accounts. Now, if you're under the age of 55, you'll most likely still have remaining mortgage to pay off, and with the interest rates rising, a lot of us is going to feel some pain. If you're on a variable rate mortgage term, you're most likely going to feel this almost immediately. However, if you're on a fixed rate, you're probably good for now, but when the mortgage term comes to an end, you're going to have to renew your mortgage with a higher interest rate than the one that you paid before. Just for example, when I took out this mortgage to buy this house a year and a half ago, when the interest rate was really low, my mortgage is at 2.14%, which means that my monthly payment to repay the mortgage back is roughly around £1,400. Now, if I were to look at a quote for exactly same property, same deposit, instead of looking at 2.14%, I will now be looking at 2.85%, and the monthly payment will increase from $1,400 to near enough $1,700 a month. However, if you're not a homeowner yet, but you are looking to buy a house anytime soon or this year, you might be in a luck, but there will be some trade-off. As we talked about before, when the interest rate rise, some of the asset prices will go down, and this will also include the house prices. However, there is a trade-off, because you are then having to pay higher interest on the mortgage. If you're a renter, you're most likely going to come under pressure, because again, the cost for the landlords will be increasing, and they are most likely going to pass on that cost to renters. Of course, this depends entirely on where you live. I know that in certain countries or certain regions, there is a cap on how much the rent can be increasing by on an annual basis. However, in England, this does not apply. Now, if you're an investor, when when the interest rate rise, typically this is viewed as a bad thing for us. And this is probably the time that I say that I am not a financial advisor, so don't take this as a financial advice. Now, one of the reasons that it is bad for investors when interest rates rise is because, especially where we're living now in 2022, many companies have gotten used to not paying a lot of interest on their debts for the past 14 years. And you will actually be amazed how much debts companies are holding. So a slight rise in interest rates can actually cause the company a lot of trouble. Now, secondly, because the cost for consumers are also rising due to interest rate rise. So for example, my mortgage now is going to be even more expensive, which means that I will have less disposable income. So the companies that we normally invest in at this point in time is not only facing a higher cost of materials, they will also be facing a higher cost of debt and most likely going to take a hit on the revenue side because the consumer are being more budget conscious, which means lower return all around and potentially lower dividend. However, it's not all bad news because the impact of the rise of interest rates will affect different companies or industry differently. Tech companies, for example, have seen the most impact because normally tech companies do require a lot of upfront capital, or i.e. debt, in order for them to fund their growth. However, I would like to point out that how the stock market has been underperforming in the past month is not purely due to the increase of interest rates, but also the fear of recession and other factors. So only time will tell how long the stock market will be in the red for. As you probably know already, that the stock market is hardly predictable. All in all, increasing the interest rates to slow down inflation generally makes sense. However, slowing down the economy too much could potentially bring the economy to a recession. And recently we've seen more and more indications that recession is just right around the corner. So I would really recommend you to watch this video next to further understand what these indicators are and what you can do to protect yourself from the risk of the upcoming recession. I'll see you there.